An 18-month countdown to the next market crash has already begun. Something's going on in the financial markets. If you look past the daily headlines and the non-stop optimism from mainstream news, a very different story is taking shape. It's a story told in months and years, not days and weeks. And it points to a specific date, a convergence of timelines from three completely different ways of looking at the world. It's a story that suggests an 18-month countdown to the next major market crisis has already started, ticking silently toward 2026. Think of it like this. You have three separate alarm clocks, all built by different people, using different parts. One is based on old-school political cycles, another on waves of human demographics, and the third is a mysterious 150-year-old chart of booms and busts. For years, they've all been ticking at their own pace. But now, all three alarms seem to be set for the exact same time, the year 2026. This isn't just one person's opinion. This is a chilling harmony of warnings from some of the most talked about, and in some cases, most controversial, analysts out there. We're going to break down the shocking predictions from Mark Chaikin, a 50-year Wall Street veteran, whose indicators are on every Bloomberg terminal on the planet. We'll get into the almost apocalyptic forecast from Harry Dent, an economist who argues that demographics are destiny, and the world is staring down a crash that could be worse than the Great Depression. And we'll look at the secrets of the Benner cycle, a 19th century chart that's been strangely accurate in calling past panics, and now points directly to 2026 as a moment of truth. But this isn't about scaring you. It's about understanding the arguments. We won't just tell you what these analysts predict, but why they predict it. We'll also do what most channels won't. We'll put these predictions under a microscope. We're going to look at their track records, including their spectacular failures, and see how their warnings stack up against what the rest of Wall Street is saying. Because right now, the mainstream view is incredibly bullish, with almost every major bank calling for gains. This creates a fascinating and potentially dangerous situation. A small group of contrarians is screaming fire, while the rest of the theater is enjoying the show. So, who's right? Are these just a few analysts crying wolf, or are they the canaries in the coal mine? By the end of this, you'll have the full picture, the alarming predictions, the critical counter-arguments, and a clear idea of what this 2026 convergence could mean for your money. Let's get into it. The warning signs are flashing red, but you have to know where to look. While most big banks are forecasting another strong year for the market, a handful of veteran analysts see something very different. They argue the AI-fueled rally of the last few years isn't the start of a new golden era, but the final, frantic gasp of a super bubble that's been inflating for over a decade. One of them, Harry Dent, put a number on it, a potential 90% crash in the stock market, an event that would make the 2008 crisis look like a minor correction. It sounds insane. It sounds impossible, but he's not entirely alone. Another analyst, Mark Chaikin, using a completely different model based on presidential election cycles, has also landed on 2026 as the year the music stops. His model flags a 65% chance of a new bear market, with a peak around mid-March 2026. And then you have the Benner cycle, an old commodity chart from 1875 that has an uncanny knack for flagging big downturns. And it also points to 2026 as the year to sell before a long period of hard times. Three different methods, three different analysts, all pointing to the same 18-month window. The clock is ticking. Section 1. The consensus vs. the contrarians. To really get the weight of these warnings, you first have to see just how different they are from the mood on Wall Street. At the start of 2026, the consensus isn't just optimistic. It's practically unanimous. A Bloomberg survey of top Wall Street strategists showed that not a single one was calling for a decline in the S&P 500 for the year. The average forecast was for a solid gain, which would extend the market's winning streak to 4 years in a row. Firms like J.P. Morgan and Morgan Stanley have been leading the bullish charge. They're pointing to a powerful mix of resilient economic growth, cooling inflation, and the belief that the AI boom is a real technological revolution, not a speculative bubble. Their general view is that the economy is heading for a soft landing. Corporate profits will stay strong, and AI will keep pushing stocks higher. The message from the mainstream is clear. Things are looking good. This is what makes the 2026 crash thesis so jarring. It's a direct rejection of that rosy picture. The contrarians Chaikin, Dent, and the followers of the Benner cycle are basically arguing that the very things making Wall Street so optimistic are actually the seeds of our own destruction. They see the AI boom not as a sign of strength, but as a classic late-stage speculative frenzy, just like the dot-com bubble. They believe the trillions in government stimulus that propped up the economy since 2009 didn't prevent a crisis, they just delayed it and made it bigger, creating a debt-fueled superbubble in stocks, real estate, and everything in between. And there's another quiet warning sign coming from one of the world's most famous investors. Warren Buffett, who is legendarily cautious when markets get frothy, has been building a massive cash pile at Berkshire Hathaway. As of late 2025, that cash hoard had swelled to a record of over $325 billion. For 12 straight quarters, Berkshire has been a net seller of stocks, trading its equity positions for the safety of short-term U.S. Treasuries. Now, Buffett hasn't come out and said a crash is coming, but his actions speak louder than words. He's effectively saying that in a market he sees as overvalued, he can't find good deals, and he'd rather hold cash than join the party. This lines up with valuation metrics like the CAPE ratio, which also suggests the market is stretched. Of course, we have to frame this correctly. Buffett is always looking for value, and that's naturally harder to find in a bull market, so his cash position always fluctuates. This all sets the stage for a huge conflict of narratives. On one side, you have the full force of Wall Street's institutional optimism. On the other, a handful of seasoned, if controversial, veterans and historical cycles, all pointing to a single, catastrophic outcome in 2026. To figure out which story is more plausible, we need to dig into the evidence, starting with the man who built his career on market cycles, Marc Chaikin. Section 2. Marc Chaikin and the Presidential Cycle. Marc Chaikin isn't your typical talking head. He's a quant, a guy who has spent 50 years building data-driven models to predict the market. He created the Chaikin Money Flow Indicator, a tool used every day by traders on Bloomberg and Reuters terminals to see where the money is going. His reputation is built on data, not drama. According to his firm, this is the guy who warned of the 2022 bear market 90 days before it hit and predicted the big recovery rally in 2023. Now, those same models are flashing a new warning for 2026. Chaikin is calling for a 65% probability of a new bear market starting that year, with an average drop of around 20% in the S&P 500 and much bigger losses for many individual stocks. He's even zeroed in on a timeline, suggesting the market will likely peak in the first half of the year, maybe around mid-March 2026. The core of his prediction isn't a gut feeling. It's based on a historical pattern that's been around for over a century, the presidential election cycle. The theory, made famous by Yale Hirsch of the Stock Trader's Almanac, suggests that the stock market follows a predictable 4-year pattern tied to the U.S. presidency. Here's how the theory generally goes. Year 1 post-election, the first year of a new term. This is often a strong year. The new president has a honeymoon period, and enthusiasm is high. Year 2 midterm. This is where the trouble often starts. The initial excitement fades, and the real-world impact of new policies starts to hit. This is often a year for a market correction. Year 3 pre-election, usually the strongest year of the cycle. The party in power wants the economy humming to boost their chances of re-election, leading to pro-growth policies. Year 4 election, the market often does well, but uncertainty about the election can hold it back a bit. Chaikin's 2026 forecast hangs on this pattern, with 2025 being the first year of the new term. His model called for a bull market, which fits the historical pattern, but he argues that 2026, as the second year, is when reality bites. The consequences of policies passed in 2025 will be fully felt, leading to a market top and a bear market. He's confident we'll see a significant downturn, likely bottoming in the fall of 2026, which would then set the stage for a big recovery. But before we take this as gospel, we need to apply some scrutiny. First, while the presidential cycle is a real historical pattern, it's not a law of physics. As critics point out, its predictive power hasn't been perfect in the 21st century. Averages can be misleading, and there's no guarantee 2026 will follow the old script, especially with the unique economy we have today. Second, Chaikin's track record, while it includes some impressive calls, like the 2022 downturn, is self-reported by his firm. It's common for analysts to highlight their big wins and forget the misses. A 65% probability of a bear market is just that, a probability. It still leaves a 35% chance that the market keeps going up. So, Chaikin's prediction is best seen as a serious, data-driven hypothesis, not an infallible prophecy. It's a compelling case that the political calendar is setting us up for weakness in 2026. But it's just one piece of the puzzle. The next piece comes from an analyst with a far more extreme and far more controversial vision for the future. Section 3. Harry Dent's Demographic Doomsday. If Mark Chaikin is predicting a storm, economist Harry Dent is forecasting a biblical flood. Dent has issued one of the most extreme warnings out there, a market crash starting in 2026 that will be the worst in history, with stocks potentially collapsing by as much as 90%. This isn't a bear market prediction. It's a prediction of a total system reset, an event he claims will be worse than the Great Depression. Unlike Chaikin, Dent doesn't care about politics or short-term indicators. His whole framework is built on one powerful force: demographics. Dent argues that consumer spending drives the economy, and spending is predictable based on age. People spend the most in their 40s and 50s. So, you can forecast booms and busts by tracking the size of generations as they move through that peak spending window. According to Dent, the huge baby boomer generation drove the boom from the 80s to the mid-2000s. The natural end of that boom should have been a deep recession around 2008 as the boomers started to retire. But that didn't happen. Instead, Dent argues, policymakers stepped in with unprecedented levels of stimulus, printing trillions of dollars to prevent the natural economic cycle from playing out. He claims this created a 17-year super bubble that has been artificially propped up by an estimated $29 trillion. He thinks this bubble will finally burst in 2026. A weak January, he says, would be the final confirmation. If he's right, he predicts a brutal initial crash, followed by a deeper cleansing phase into 2028. In this scenario, he sees nowhere to hide. Stocks, real estate, even gold and Bitcoin get crushed. The only asset he thinks will survive is U.S. Treasury bonds, because the government can always print more money to pay its own debt. Now, this is where we have to pump the brakes and add a heavy dose of skepticism. Harry Dent's predictions are sensational, but his track record as a market timer is, to put it mildly, deeply flawed. For decades, Dent has been predicting the crash of a lifetime. He's been described as a great demographer, but a truly lousy predictor of stock market actions. Let's look at the history. In 1999, he published the Roaring 2000s forecasting a huge boom. The dot-com bust followed. In 2009, at the exact market bottom, he published the Great Depression ahead, right as one of the longest bull markets in history was kicking off. He predicted crashes or major deflations in 2012, 2014, 2017, and 2022. None happened as he described. An analysis of 9 of his major predictions found he was dead wrong on 7 of them. If you had followed his advice, you would have missed out on historic gains. This doesn't automatically mean he's wrong about 2026. Even a broken clock is right twice a day. And his underlying thesis about the consequences of record debt and demographic shifts is a serious concern shared by many economists. But his specific, apocalyptic timing has been wrong far more often than it's been right. His 90% crash prediction should be seen as a highly speculative, worst-case scenario from a known permabot, not a probable forecast. Section 4. The Benner Cycle, a 150-year-old prophecy. Our third and final piece of evidence is by far the most mysterious. It's not from a Wall Street analyst or a fancy computer model. It's a simple chart created back in 1875 by an Ohio farmer named Samuel Benner. After getting wiped out financially in the panic of 1873, Benner became obsessed with market cycles, believing they were driven by natural rhythms. The result was the Benner Cycle, a hand-drawn forecast of booms and busts that has shown a strange ability to flag major turning points for over 150 years. The Benner Cycle divides time into three phases. A year's panic, years of crisis when markets often crash. B years good times, periods of high prices and prosperity, and the best times to sell. C years hard times, periods of low prices and depression, and the best times to buy. The cycle is based on repeating patterns of 8-9-10 years for peaks and 16-18-20 years for panics. What's wild is its supposed track record. Proponents claim the Benner Cycle pointed to the market peaks before the 1929 Great Depression, the 2000 dot-com bust, and the 2008 financial crisis. So, what does this 150-year-old chart say about right now? It labels the period of 2023-2026 as good times. More importantly, it marks 2026 as the final year of this phase, the last major selling point before the cycle shifts into a long stretch of hard times. But let's be realistic. This is a 19th century commodity chart, not a scientific tool for predicting modern markets. Today's markets are infinitely more complex than they were in Benner's time. The claimed accuracy of the cycle is often a case of looking back and making things fit. It's easy to look at a vague chart and find correlations that seem predictive after the fact. The cycle also lacks precision. While it points to 2026 as a peak, some interpretations suggest the selling period could last until late 2027, which is a pretty wide and unhelpful window. Ultimately, the Benner Cycle is more of a fascinating historical curiosity than a reliable forecasting model. It's a powerful reminder that markets move in cycles of greed and fear that haven't changed much over the centuries. The fact that its timing lines up so neatly with the predictions from Chaikin and Dent is what makes it so interesting here. It's the third, unexpected alarm clock, built in a different century, suddenly ringing in harmony with the other two. All right, processing all of this, the scary prediction, the flawed track records, the conflicting reports can be a lot. Figuring out what to do with your money in an environment this uncertain is one of the biggest challenges an investor can face. Whether you believe these warnings or not, being prepared is what matters. Real financial security doesn't come from timing the market perfectly. It comes from building a long-term strategy that can handle volatility. It comes from having a plan. If you're looking for some guidance on how to build that kind of plan, how to diversify, and how to navigate whatever the market throws at you, I encourage you to click the link in the description below. You can connect with a qualified financial advisor who can work with you on a personalized strategy. In a market this noisy, getting expert, one-on-one advice might be the most valuable investment you can make. Don't wait for a crisis to start planning. Click the link to learn more. So, where does all this leave us? We're looking at a huge disconnect. On one hand, the broad Wall Street consensus sees clear skies for 2026, with continued gains fueled by AI and a strong economy. On the other hand, you have three totally separate counter-narratives all pointing to that same year as a moment of crisis. Mark Chaikin's presidential cycle analysis points to a probable bear market starting around spring 2026. Harry Dent's demographic model forecasts a catastrophic 90% crash, and the historic Benner Cycle signals 2026 is the year to sell before a long downturn. We've also seen that each of these warnings has some serious weak spots. Chaikin's cycle theory has exceptions. Harry Dent's doomsday predictions have a long history of being wrong, and the Benner cycle is a fascinating but unscientific 19th century chart. It would be a mistake to take any of these predictions as a guarantee. No one can predict the future with 100% accuracy, but it would also be a mistake to just ignore their convergence. When multiple, independent lines of analysis all point to the same general outcome, it's a signal that's worth paying attention to. The core ideas behind these warnings: record debt, extreme valuations, the end of a demographic boom, and the cyclical nature of markets are all very real risks. This isn't a call to panic sell everything and run for the hills. In fact, analysts like Mark Chaikin specifically advise against that, pointing out that a recovery always follows a downturn. Instead, this is a call for vigilance, a call for critical thinking and for preparation. It's a reminder to look at your portfolio, understand how much risk you're taking, and make sure your financial plan is solid enough to handle a storm if one comes. The 2026 crash narrative might be over the top, and the alarmists might have their own agendas. But the evidence they present, even if flawed, highlights real vulnerabilities in the system. The countdown may or may not be real, but the risks certainly are. Stay safe and stay informed.